money, the principal payment, make that principal payment into a side account towards retirement planning and only pay the interest portion on your loan.
So when you say to make the money into a side account, as a financial advisor, things I think of are placing monies into a Roth IRA if appropriate, take monies and put them into tax-deductible retirement types of plans, take money and put it into permanent insurance, and or something earmarked for college savings, because that's all a priority for most people that have young children.
Well, there are many vehicles that are available to the consumers and the financial planning industry that is out there. We at Forgotten Equity, we don't advise on where to place the money, nor give tax advice. We serve, our website really serves as a three-purpose function. One is to educate the consumers to a different way of thinking. And then we do have licensed professionals all across the country, where I think we're currently in 45 states. There's a few states that we don't have a subscriber base at. And we've designed proprietary software to help our financial planners and our mortgage planners across the country explain these things to their clients.
Can we have the consumers go to the website to look and see, or look at some of the calculators that are available so they could take advantage of this education and insight?
Most definitely. We have, there's two sides to our site. The consumer side, it's right there. It'll say consumers, click here, or homeowners. And it goes through kind of an educational piece. It'll describe equity and rate of return and interest-only loans. We have an example on our website, for argument's sake, that illustrates if you borrow money, the illustration we give is a $300,000 loan at a 6% 30-year fixed mortgage. And what will happen over the 30-year cycle, in 5-year snapshots, how your mortgage gets paid down. And at the end of the 30 years, this consumer is now left with zero balance on their mortgage, house is paid off, and they've paid out significant cash, both in principal payments and interest payments to the bank. What we show them is how to then change their way of thinking. Let's go to an interest-only loan. We illustrate it at 4.25% for the sake of illustration on our website. And let's now invest that difference monthly. Take the 30-year fixed payment, what that would be, versus the much smaller interest-only payment, and let's invest that on a monthly basis into this side account, which I know we'll touch on a little bit later again.
Yeah.
What happens is the goal for most people is to get their house paid in full. Lo and behold, by changing the style and methodology and how you make your payments, let's not make them all to the bank, let's redirect some of our payments. After 19 years, that side fund, only earning a 6%, a very conservative rate of return, earning 6%, in 19 years, we'll have $313,000 in there, more than sufficient cash to be able to pay off a $300,000 interest-only loan. Conversely speaking, the person who is on an amortized loan on a 30-year schedule still has about $171,000, $72,000 remaining balance on their mortgage.
Now, are you factoring in any type of tax benefit in this conversation?
On that example, no, we do not. But one of the things that we advocate, let's talk about your interest-only loans versus amortized. An amortized loan,
which is a 30-year,
30-year fixed year, or 15-year fixed mortgage.
Principal and interest.
Correct.
Okay, good.
What happens is every year, as persons grow older, you're 30, you're 40, you're 50, and we have what we call the earnings J-curve, which means you're starting out here and your earnings slowly start to increase as you get older in life.
Right.
Conversely is when you have an amortized loan, again, the fixed mortgages with principal and interest payments in, is every year the J-curve is doing the exact opposite. Your tax deductions are decreasing with every mortgage payment you make on an amortized loan.
Right.
We describe that as actually going through life with one foot on the gas and one foot on the brake. You're still going to get where you want to get to, but your car's going to be a lot worse off shape. Same thing when it comes to home planning and retirement planning. You'll eventually get there, but you're not going to be in the position you thought you might be in when you first started your plan.
We've had a tremendous run-up in real estate prices. It's one of the consumer's largest financial assets in their portfolio. And you're really up against a mind shift, a mindset, and they have to be open-minded to hearing some of these thoughts and be able to take advantage of some of the strategies.
Correct. The most difficult process, I've had engineers for clients, we've had financial advisors, I've had Wall Street executives as some of my clients. The most difficult thing is fundamentally, they agree with everything we say. Mathematically, you cannot disprove what we're going to show you,
right?
How we're going to educate you. But it comes to the emotional side of things. Things are done emotionally. And that emotion you mentioned earlier stems back to the Depression era. During the 20s and in the early part of the 30s, the banks had due-on-demand clauses. So what happened was the Great Depression came around, banks needed cash, so what did? They called up their people. Pay me your note, or within 120 days, we're taking your house back. People lost everything they had. Their life savings was in their home. Congress changed the rules back in the 30s. Due-on-demand clauses disappeared. However, people, when you have a bad experience, you don't forget it. Now our grandparents, for most of us, or many of us are parents, or even some of the people watching might actually have been them, who were still with us in their upper ages. What happened was they said, you know what, the laws changed, but I don't care. I don't ever want to lose my house again.
Right, base.
And you referred to back in the 60s, the mortgage burning parties.
Yep.
Well, let's think back. What happened was people took out new mortgages, paid them off aggressively because they don't want to take their house back again, had a mortgage burning party, and were just loving life on mortgage free. And they tell their children and their grandchildren, don't let that happen to you. Pay off your mortgage. And the entire industry today concentrates on how can I save money on my mortgage? How do I pay it quicker to wipe out this evil thing called a mortgage? But we educate clients how to make money with your mortgage.
You know, what's interesting is as a financial advisor, and I meet a lot of people, they have needs. And specifically, a need is to either buy a first home, buy a second home, or send their kids to college. And very often in the question and answer conversation, I'm asking, well, what type of planning have you done for the children's educational account? And they say to me, I'm going to look to take a home equity or look to refinance their mortgage to fund the kids' education. What are your thoughts on that?
Well, it depends on how we're going to fund it. One thing I want to make really clear to all of our watchers out there is we do not advocate consuming your home equity. We are conserving your home equity. Well, we want to make sure that the financial planners and the financial advisors you're working with are really on board. They've done the research. They read. There's a lot of books out there. And the mass media is really touting one thing, and we're completely different than that. You know, there's the 529 plans for college planning, or just paying for colleges outright. We're not necessarily agreeing that those are the best alternatives out there. There are methodologies to what we call harvest the equity out of a house and put it to work for you in some of these side accounts.